Hello, Accounting 101 students. In this video, we are going to go over how a company will compute the revised annual depreciation when it changes its useful life or its salvage value. So we're going to go ahead and do this with question number 4. Another topic that we will be covering is recording the gain or loss when we dispose of a fixed asset, and we will be doing this with question number 3 in our Chapter 9 end of chapter practice exercises. So in this example with question 4, we have Victor Manelli, who is a new controller of a company that is reviewing the expected useful life and the salvage values of a few of their depreciable assets at the beginning of 2017. And in this problem, we have two assets that we're dealing with. We have our building and our warehouse. We notice that the date acquired is January 1st of each of the respective years. We are given the initial cost of each of these two assets, as well as the accumulated depreciation as of January 1st of 2017. Also in this problem, we are given the initial useful life, as well as the proposed useful life. So we want to think about, well, when we revise our depreciation, how many years are remaining among the proposed useful life? And then we have our salvage value. We have our initial salvage value as well as our proposed salvage value. And all assets are being depreciated using the straight line method, and the company uses a calendar year. So one of my suggestions when it comes to a question is to draw out the T accounts to help you visualize what was in each of these accounts before you record your revised depreciation. So we're going to go ahead and get started with our building, which had an initial cost of $838,000. And we also note our accumulated depreciation on that building has a credit balance of $156,500. So when we start this problem, we want to know, what is our net book value of that building on January 1st? 2017. So you'll remember that the net book value is going to be the cost. So we're going to take 838 minus the accumulated depreciation. And this is important because we want to know how much is left to depreciate on this building. So we have $681,500 that is left to depreciate. Then we can compute our revised depreciation, and our formula for our depreciation is our cost minus the salvage value. But instead of using our cost when we're revising our depreciation, we're actually going to be taking the net book value, whatever is left from the cost that has not been depreciated yet, divided by the useful life. And for this, we're going to be considering the remaining or the proposed useful life. So we're going to go ahead and start off with $681,500 minus the proposed salvage value of $35,700. And once we have that, we're going to divide that by our useful life that is remaining. So our proposed useful life is 48 years. And we want to realize that we have some years that have already passed. So if we acquired this building in 2009, that means that we depreciated it in 2009, 10, 11, 12, 13, 14, 15, and 16. So we've already depreciated this for 8 years. So that means that we have 40 years left to depreciate this building. So that will give us our annual depreciation, which is revised to be $16,145. The next example that we're going to go over is for our warehouse. So on this warehouse, we had purchased this for $116,000, and our accumulated depreciation is going to be a credit balance of $22,250. So once again, we need to come up with our net book value on the warehouse on January 1st, 2017. And that will be determined by taking 116,000 minus 22,250. So we get 93,750. Now we need to compute our revised depreciation, which will be our remaining balance that is left to be depreciated, so 93,750 minus our new salvage value of 4,300 that is given to us in the problem. And we're going to divide this over our proposed useful life, which is 20 years. However, as some years have passed, we have already depreciated this warehouse for 2012, 13, 14, and 15. So we've already depreciated this warehouse for 4 years. Actually, it's been 5 years. All right. So once you do the math here, then you're going to end up with 5,963. All right. So the next problem that we're going to go over is what happens when a company is going to dispose of a fixed asset. So we're going to do this with question number 3. And before I move on to question number 3, just one last part of question number 4. The journal entry to record the depreciation on the building is going to be a debit to depreciation expense and a credit to accumulated depreciation on the buildings for that same amount of $16,145 that we recorded in our first part. In question number 3, we have this old factory machine. And for this old factory machine, we have our cost and we have our accumulated depreciation. And we have 2 different scenarios if the company decided to sell the machine. So this is another area where it is very helpful to draw out the T accounts, because when you dispose of a machine, you also need to get rid of the accumulated depreciation recorded on that machine. And if you receive cash, you need to record the cash. And obviously, you might have a dollar difference between the cash received versus the remaining net book value. So we're going to start off by recording our accounts. So we have our equipment account, and we have this debit balance of $50,750. We have our accumulated depreciation on that equipment with a credit balance of $28,420. And we're going to use that information for both scenario A and scenario B. So in scenario A, what would be the journal entry if they're going to sell the machine for $25,375 in cash? So if that was the case, that means that the company received cash. So we're going to debit the cash account for the amount of cash received. So $25,375. And that will correspond with a debit in our journal entry for cash of $25,375. When we sell our equipment, we no longer have our equipment, so we need to record a credit to the equipment account of $57.50. And we also need to get rid of this accumulated depreciation for its corresponding amount. So basically what happens here is we need to get rid of the equipment and the accumulated depreciation because we don't have these two anymore. So you'll see in our journal entry, we're recording a credit to equipment and we're recording a debit to the accumulated depreciation on that equipment. So now you need to look at your total debits and your total credits and notice that these do not match up. Okay, so far our total debits for part A, I'm going to add up $28,420 plus $25,375. So my total debits are $53,795. And this is not equal to my total credits, which are $50,750. So I need to figure out what is my X in order to make these two equal. So my total debits have to equal my total credits, and so far these do not equal out. Okay, so my total debits are $53,795. My total credits are $50,750. So I need to solve for X. So X equals 3,045. So that's going to be reported on the credit side. And you'll notice that the wording here is we have a gain on the disposal of a fixed asset. And that's really because the cash received is more than the equipment minus the accumulated depreciation. So you'll notice that the gain is a credit. Similar to how revenue is a credit, and gains are going to increase your net income. So they would increase your retained earnings and increase your equity, which are all on the credit side for our accounting equation and our debit and credit rules. The next scenario we're going to go over is with our cash that's being received, but this time we receive less cash. So our debit to cash is $15,225. You'll notice that my debit to accumulated depreciation and my credit to equipment are for the exact same dollar amount. But this time I'm going to compute my total debits and my total credits. So this time I'm going to add up my accumulated depreciation plus cash, plus I need an additional debit in order to equal to the credit of $57.50. So this time I have a loss on the disposal of a fixed asset because it's on the debit side. So you'll want to pay attention to the side.